The IRS, they have 7 years to go back and review your taxes. It will catch up with you. Accountants who charge less are actually doing a disservice to themselves and their clients. This was the first time that my client had heard about them being eligible for this tax deduction. But realistically, they've been eligible since 2017.
That profit bucket is already taxed in the business. So that's why on the personal side, when I receive a distribution of $10,000, that's not taxed on my personal side because it's coming from the profit bucket that is already taxed in the business.
Correct. And that applies only to S corporations, partnerships, and single member LLCs. And it's not in all circumstances either, but for the majority of circumstances, it'll apply.
Gotcha. Okay. Speaking of LLC and S Corp, to the regular everyday new business owner out there, they're confused about all of these things. They don't know the differences. When I was working as a consultant for the SBDC, everybody's like, what's the difference between LLC and S Corp? What should I do? C Corp, unpack the whole thing for us now.
Yeah, I don't know if I could do that in just a short amount of time, but what I can say is the most common question I hear is, LLC or S Corp. And for the average business owner just starting out, typically the LLC will make the most sense right out the gate. Of course, get professional advice specific to their situation from either a business attorney or a CPA. But that being said, the LLC is very flexible in how you can arrange it. You can actually start with an LLC and convert it to an S corporation down the road if it ever makes sense. LLC will be good for most business owners until they start producing about $80,000 in net profit. After all their expenses, $80,000 at the end of the year, then you want to start considering the S corporation.
Oh, wow.
The reason for that is because the S corporation comes with a lot of additional administrative burden. So it requires a separate business tax return. It requires payroll processing for the business owner. It requires its own estimates and depending on your state, a different state tax return as well. And all that can be a lot for the small business owner to have to track and manage. And so what they end up doing is they end up paying a professional. Well, a professional on average for the administration of an S corporation will charge anywhere between $3,000 to $5,000 per year. So even though the S corporation does provide some tax savings, it's through a self-employment tax. LLCs are subject, their net income are subject to 15.3% self-employment tax rates. S corporations are not subject to that 15.3% tax, except for the amounts that the owner pays themselves as a salary on their W-2. So when you're calculating the tax savings, you also have to consider whether or not the $3,000 to $5,000 in professional fees are covered by the tax savings. If you go S Corp too early, let's say $40,000 in income, well, maybe the tax savings that you would have are all washed away because now you have to pay a professional to administer that S corporation for you. Mm-hmm. So that's where we get kind of that $80,000 recommended threshold. It depends on each professional's fees, but around $80,000 net income after expenses, the tax savings start to make more sense for that S corporation.
And how does it work to convert an LLC into an S corporation?
There's a form. It's called Form 2553. It's an S corporation election form. It takes the business's names, the business's information, the owner's information, and it's essentially a statement that's submitted to the IRS stating this business would like to be taxed as an S corporation starting for this time period. And we have the consent of all the owners. All the owners have to submit, or they have to sign and consent to that tax status for their business. And then you send that over to the IRS. They will receive that election. You can just mail it in at any time of the year. It doesn't have to be during tax season. And then they'll send a confirmation letter letting you know that the business is now set up as an S corporation and you need to file the S Corp tax return for the next year.
So between a business that started as LLC and then submitted that form to be elected as an S Corp and a company that starts from the get-go as an S Corp, is there any fundamental difference?
Not necessarily. There can be in certain situations. So this is a big thing in the tax world is it depends on a lot of different things, right? An LLC can go to S Corp. Usually there's no issues or complications. A C corporation can also convert to an S corporation, depending on the nature of the business and how much profit the C corporation has before it becomes an S corporation. Sometimes there's certain tax implications there where, C corporations are subject to a different tax rate. S corporations are a completely different tax rate in how they tax their income. So the IRS won't just let you take the lower tax rate and then convert to the other one and then start paying out, the owners or anything like that. They still keep track of profits from each stage of the business to make sure that if I earned $200,000 over the last 3 years and I didn't distribute it because I didn't want to pay taxes, but then I did an S corp, now the distributions are not subject to tax. Only the profits are. I try to take those distributions out. The IRS keeps track of how much of those distributions were from before I was an S corp, and then will try to tax me on that appropriately. So for the most part, there's no difference between starting out as an S corp and then converting to an S corp, except in certain situations, like I just detailed there. And again, consult with a professional on anything that might relate to your specific situation.
What did you talk professional here, like legal professional, like attorney or?
Legal or tax.
Okay.
CPAs are very well versed. Find a CPA that you can trust.
Which is you.
Yes. Yes.
So when you're saying that, is that, you need to dig deeper into that individual business to give a professional recommendation and not just on a podcast like that. That's what
it depends. Yes. Yeah, definitely.
Okay. So let's say in our case, Perus Lab LLC, the LLC came because the original submission was an LLC.
Right.
Now, when we become an S Corp, do we drop LLC from the name or does the LLC remain there?
Good question. So the LLC can actually remain there because the LLC is being taxed as an S corporation. You wouldn't call it Perus Lab S corporation or Perus Lab
Inc.
Inc. Because it's not a corporation. It's an LLC being taxed as an S corporation.
Oh.
The S corporation is only a tax status. You can't tell the state of California, I want to start an S corporation. You either have to form an LLC or a corporation and then tell the state and the IRS that you want it to be taxed as an S corporation.
So what's the difference between an LLC and a corporation?
There's actually a lot of differences, very nuanced. Yeah. And it's probably a question best answered by a corporate attorney.
Okay.
But from what I can answer on that question is that LLCs generally are a lot more flexible in how you can operate it and what kind of members can form that LLC, what kind of business partners can come together. Corporations are a lot more restrictive in how to divide up the profits, how much can be distributed from the corporation, a lot of the decision making that takes place. Formal corporation requires, board of directors, board of directors, annual meetings, meeting minutes, shareholders meetings sometimes. And so it is a distinct difference. And you would want to consult with a professional about which one makes the most sense. LLCs are very flexible and accessible. Not every state has LLCs either, though. LLCs were created by the state of, I want to say Wyoming or Delaware.
Really?
And then all the other states started to follow suit because they saw how attractive it was for business owners. And then each state wants to generate investments in the state, more economic activity, create jobs. So they started creating LLCs as well. So there's different, each state has different rules on their LLCs, but it's not something like you can't form a federal LLC. Mm-hmm. But all states are subject to corporate law, federal corporate law. There's no such thing as federal LLC law.
Gotcha.
That's my understanding. I'm not an attorney.
Yeah. But there's also, I'm sorry if I push for these answers because I think they are really, like, a lot of people have these questions. What about starting a DBA just without any LLC or like a sole proprietor type deal?
Yep. Generally would not recommend it. And the reason being because LLC and corporations have separate liability protections. Actually, in the name LLC, it's limited liability company. It's in the name that it limits your liability as a business owner operating as an LLC. As a sole proprietorship, like a DBA, essentially what you're telling the local government is that, or the government is that let's say Claudio Gil, I'm operating like a print shop, or, I like to sell printers on the side or something like that. My DBA is Claudio Gil Prints. And essentially I'm just operating as myself, but the DBA is where all the branding and like that name lives. So when someone contacts Claudio Gil Prince, I'm Claudio Gil doing business as Claudio Gil Prince. And there's no separation between what Claudio Gil Prince is and what I am. So if someone wants to sue Claudio Gil Prince, they're not suing Claudio Gil Prince, they're suing Claudio Gil. Whereas in an LLC, if I have Claudio Gil Prince LLC and someone wants to sue Claudio Gil Prince LLC, then they're going to sue the LLC. And if I've maintained the LLC correctly, filing taxes, being compliant, then they're not going to be able to sue me personally, except for very specific circumstances.
So, for example, if someone is operating a sole proprietor DBA and they own a house and cars and whatever properties they have, and someone sues them, they can go after their personal property.
That's right. Yep. So they can, retirement accounts are involved in that. Income from W-2 jobs. So even if you're like an employee at McDonald's, if someone sues you and gets a successful judgment, they can garnish your wages, depending on certain circumstances.
Wow.
It's a very high risk way to operate a business as a sole proprietorship.
Where with LLC, they can't do that?
Except very specific circumstances, yeah. So you have to, there's a concept called the corporate veil, right? And in the corporate veil, essentially, there's a veil of protection where if someone tries to sue the LLC or sue the corporation, they're not going to be able to go after the personal owner's assets. If you don't maintain that corporate veil, then in a court of law, someone sues the corporation or the LLC. The court says, you have not been running the business the way that a business should be run. You're commingling expenses. You're treating the business account like a personal piggy bank. You're going on vacation using the business funds and you're not paying your employees or whatever the case is. The court can decide your corporate protections no longer exist. We're going to allow them to go after you personally as well, because they're not treating the business as they should.
Yeah.
Right?
Yeah. And this brings us into that very common practice, which is mixing personal with business expenses, business income versus, so the whole thing comes to one bank account, basically.
That's right. Yep. So you want to avoid that for sure. If you're commingling funds, you're at risk of losing your corporate protections. Other things that will lead to violating or piercing the corporate veil, not filing your legal forms. For LLCs in California, typically it's every 2 years, there's a filing requirement. This is separate from the tax returns. This is something that you file with the Secretary of State for each state. For LLCs, it's every 2 years, corporations every year. Tax returns, make sure that you're filing your tax returns and you're on time. Tax payments, you can't have outstanding tax balances with the state. They will suspend your entity and then technically you're not able to do business with that entity anymore. Mm-hmm. Or as that entity, you're not able to transact.
So what are the dangers beyond the corporate? Some people will say, oh, nobody's going to sue me. I'm okay. But why it's not good to mix personal and business expenses and business finances in one bank account?
So outside of the corporate protections being compromised, you also will piss off your accountant. And let me explain what I mean. So at the end of the year, when you need to prepare your taxes and you need to find your business income and expenses so you can declare it on your taxes, if you hand over to your accountant one bank account that has a bunch of personal and business expenses, that accountant is going to have a very hard time trying to figure out which of those expenses or income are for the business versus you personally. You can't deduct personal expenses. That's just right off the bat. Don't even try to push it, right, with the accountant. It's not going to be good for you, for the accountant, whatever. So if you have a bunch of commingled expenses and you present that to your accountant, some accountants would help you identify which transactions are for business, and they'll go and they'll prepare it. They might charge you extra for that additional work. Instead of if you just provided only business income and expenses, then they can take that information without having to do additional work. Depending on each accountant's approach, they're going to push those statements back to you and say, hey, this is great, but you need to exactly identify what we can actually use for the tax returns. And then that creates additional work for yourself. So if you're commingling business and personal funds, you're you're not only going to compromise your corporate protections, your legal liability protections, you're also going to either create more work or pay more in professional fees to organize those commingled expenses.
Yeah, 100%. I used to tell my clients in SBDC the same thing. And you'll be surprised how many people like I think they're in their mind, like they think that they're being like they're outsmarting the system.
Right.
You know, they think that, I'm going to hide all of that shit.
Yeah. Yeah.
You know?
Not worth it. The IRS, they have 7 years to go back and review your taxes.
Yeah.
So it will catch up with you.
Yeah. We touched on this last time we talked about the difference between tax filing and tax planning. And a lot of the times, and I would say 90% of business owners that I know, they will come to tax season and they will go to their accountant one time a year and they put all of their document there and say, okay, get my taxes done. Mm-hmm. Why is that a bad idea?
It's a terrible, terrible idea. And the reason for that is, and I can actually illustrate this with the recent case study. I think just yesterday, I was speaking with one of my clients. It was their first tax planning session with me, so it's a newer client. In the past few years, they've been working with their accountant who's been doing their bookkeeping and filing their taxes. Nothing beyond that, okay? The client told me their accountant would just show them the numbers based off the work that they did, that this is what it is. There's no change in the outcome. I mean, we prepared your taxes, pay this much, and be done with it. Well, during our first tax planning session, we identified a tax strategy that's going to generate $66,000 in deductions. This taxpayer is at the highest tax bracket, 37% federal, and then 13% California. So that's 50% of their income is subject to tax. When you create a deduction for $66,000, you reduce their taxes by $33,000 because of the 50% combined tax rate. And this was a deduction that has been available in the way the tax code is set up, specifically for California taxpayers, called the pass-through entity tax. And people can do some research online about that and whether or not it makes sense for them, bring it to their accountants. But they create a federal tax deduction based off that $66,000. And this was the first time that my client had heard about them being eligible for this tax deduction. But realistically, they've been eligible since 2017.
Wow.
And so when I brought this up to my client, I mean, they almost didn't believe me because it was like such an obvious tax strategy that we were going to implement for them. I showed them the California website. It has California pass-through entity tax. It explains how it works. Their one question, after they asked a couple questions that I was able to answer, they asked me one question, well, why haven't I been doing this in the past? And I couldn't answer that question for them because that's a question for their previous accountant.
Correct.
But they're not working with that accountant anymore, right? They're working with me. So moving forward, we're able to get them on tapping into some of those strategies that they've been available for. And you only have that opportunity when you check in with someone before you file your taxes. If you wait till the end of the year, January, February, March, April, that opportunity is gone. That to be eligible for that specific tax strategy, you have to make payments by June 15th of the year before.
Yeah.
If you miss that, there's nothing you can do to claim it.
And that example that you showed illustrates not just in your area, in your field, but it's almost in every field. Like you work with one person and you think that's it. That's what I get. But then you see other expert in the field and they're like, oh, they show you the different strategy that will save you thousands of dollars, like what you did. The same with my world. Like people come, oh, we used to work with a marketing agency and they used to do that. And then the results are this. And then when they start working with us, it's like a different result. So the idea here is that a lot of people will go frugal. So they will hire the cheapest. Yet there's a reason why those people are charging
those cheap prices.
Cheap prices is because of they're not even at the level of the big players in the game or the people who know their stuff. And the reason why the people who know their stuff charge higher is because they know their stuff. So a lot of the times frugal is great when you're buying toilet paper, but when you want to buy like professional services, frugal is not always the right approach.
100% agree with that. Yep. And I think accountants, and this is more, I guess, my personal opinion, but accountants who charge less are actually doing a disservice to themselves and their clients. And the reason for that is because it's great to work with an accountant who is affordable and has very low fees, but you're not the only person working with them. There's hundreds or thousands of other people who are trying to get that one person's attention to ask them questions, to get responses, to get the help that they need, to do the bookkeeping, whatever it is. And when that one accountant is managing their time, across 200, 300 clients who are all paying low fees, then they don't have the extra time and attention to answer your specific questions or give you good advice. Maybe they're making more mistakes because now they have to manage 300 types of bookkeeping clients as opposed to 100 or something like that.
Yeah.
And it does a disservice, I think, to the client at the end of the day, where an accountant charging higher, they're going to work with less clients, but be able to provide that extra service and attention that client deserves and is paying for.
100%. A lot of another big common question is that as a business owner, how do we get paid from the business?
So yeah, let's try to answer this one.
Okay.
So in specific circumstances, depending on your business entity, there's certain rules about how you have to pay yourself. Okay. As corporations, they need to process payroll for their owners. Single member LLCs that are not taxed as an S corporation, they don't require any form of distributions, and they don't really keep track of them for tax purposes either. So as a business owner, first and foremost, you want to be able to cover your operating expenses. If you can't cover your operating expenses, it's going to be very difficult to pull money out to pay yourself. After you've gotten past that stage where the operations are sustainable, they're covering their own expenses, and now there's some profit to pay out to the owners, then you want to take out enough that is still going to leave money in there to reinvest back into the business to support future growth. So if a business, it really depends on each specific business, but the concept is the same. If a business is producing $10,000 extra profit at the end of the month, maybe you want to set aside, you want to set some aside for taxes, then you want to set the rest aside for future investment back in the business, and then take out the rest as a personal distribution or a payment for yourself.
Right.
Your taxes are going to depend on different sources of income, and married couples typically have two sources of income, so their tax rate might be a little bit higher. So one business owner might set aside 30%. The business owner that I mentioned might set aside 50%, right? That's for taxes. For investing back into their business, starting out, there's typically a lot of investment that's required. So you want to try to keep as much back in the business as possible. But then after, year 3, year 4, year 5, the business is pretty much sustainable. It's reached its foundation. It has a solid investment base. And then you can start taking out more of those funds as personal distributions.
When it comes to S corporation and start paying the owners as a payroll, they become like employees type.
That's right.
So how much do we get paid as owners?
So the IRS has a required amount to pay yourself, but it's it can be considered subjective because all they ask for is a reasonable salary. Well, what the heck does a reasonable salary mean, right? What's reasonable to me might not be reasonable to you. And it depends on very, very numerous factors inside that business as well. So for a business owner who's an employee of their S corporation, how does that business owner spend their time as an employee? Are they playing the CEO role? Are they doing the manager role? Are they also spending time as a janitor, in their business? They have to clean up. They have to manage the marketing, the administrative work. Someone who's wearing all those different hats is going to get paid different from someone who's just doing business development, who's just going out there doing sales. They have the rest of the team in place, and those people are going to be paid differently. At the same time, you can take it even further. S Corp owners typically want to try to pay themselves a low salary to minimize their payroll taxes that they have to pay on their salary. Well, with the time you spend as a janitor, should that be paid the same rate as the time you spend as the CEO of the business? Right? Does the janitor get paid the same as the CEO? Not really. Mm-hmm. Well, if I spend in an 8-hour workday, if I spend 4 hours as a CEO, 1 hour as a janitor, do I then have to, pay myself let's say minimum wage for the janitor work or something that's more reasonable for a janitor compared to a fixed higher amount for the CEO time that I spend on the business. And what does that look like every single day and every single week? You can get very nuanced with it. And you typically want to divide your time and start tracking it like that so that you can't, no one will reasonably say, I spend 80% of my time in my business as a janitor, right? And then only pay yourself 20% as a CEO. IRS will not consider that reasonable. But you save a lot more money on payroll taxes if you divide up your time like that, janitor versus admin versus marketing versus CEO, because now instead of paying yourself a CEO salary for all the work that you pay yourself a smaller amount for the janitor work, higher amount for the CEO work, but overall you pay yourself less, so you pay less payroll taxes. It's very, very nuanced. It's very nuanced, but that's what we do during our tax planning sessions is help determine a reasonable salary. The business, a business that makes $100,000 is going to pay less than a business that makes $400,000. So those are all different factors that we consider. We live in Southern California. A company in Arkansas is going to pay a different amount just based off cost of living. So those are other various factors as well that we can consider as part of the reasonable compensation.
Gotcha.